Hi, welcome to Hospitality Accounting. We are going to be studying Chapter 2, Business Formation, Important Decisions. So in hospitality, oftentimes people would like to start their own business. So we're going to talk a little bit about starting a business and business formation, the different entities you can choose when you go to start a business. So first, we'll talk about how to get started to start your own business. And the first thing you should do would be a feasibility study. A feasibility study means to research the likelihood of success. So when you go to do a feasibility study, the things that you would want to do would make a business description. Exactly what does your business do? Are you going to be a restaurant? Are you going to be a fast food restaurant? Are you going to be a fancy restaurant? Are you going to cater to business people? Are you going to cater to families? Then you would also want to decide, look at the market research. Are there fast food restaurants in your area? How well are they doing? How close together are they? Then you'd want to look at location. So where is your business going to be? And in location, you might want to think about the taxes for the area, how easy it is to get there. Is it a busy street? Is a busy street a good thing or a bad thing? Things about parking. And then you might want to look at competition. Are there 5 fast food restaurants already there? Are there fast food restaurants and other types of business? Who are you competing with for local dollars? Then you might want to think about what equipment you need and estimate your revenues and expenses. How much money is rent? How much money is advertising? How much money is taxes and insurance? And then how much money you think you're going to bring in. You probably also want to realistically say, if I'm working full time, what are my personal expenses and how much revenue do I need to bring in each month so that I can cover my own personal expenses, so that I am not going into credit card debt while I'm making sure that I can pay myself. Next, we'll talk about the different forms of business. There are sole proprietorships or proprietorships, partnerships, and corporations. And then there's another one called a limited liability company, and it kind of has some of the characteristics of both a partnership and a corporation. So in a proprietorship or a sole proprietorship, there's just one single owner, just one person. So if you are, let's say, a husband and wife, you are a partnership unless you are going to say that only the husband owns the business and the wife is just going to be an employee or a helper. But in a proprietorship, it is just a single ownership. So if that husband and wife divorced, the ownership would only be in that one person's name. There are many pros to a proprietorship. I think the biggest one is that it's really easy to form. If you wanted to go into business and you wanted to be a sole proprietor, you could do so tomorrow. You could just go outside of your house, start a lemonade stand, and you would be a sole proprietor. That's all you would need to do. Also, there's very little regulation. The government's not telling you how to run your lemonade stand. They're not telling you about what you need to do for healthcare and all that kind of thing. There's very little regulation. You keep all of the control, so you as a sole proprietor gets to make all the decisions. You don't have to fight with anyone or have anyone tell you what to do. And you keep all the profits, so if your lemonade stand is profitable, it's all for you. There are definitely cons to a sole proprietorship. Probably the very biggest and scariest is that you have unlimited liability and you can be sued for your personal funds. So if you gave someone bad lemonade and they got sick, they could sue you. They could take your business, but they could also take your personal checking savings account, your home, your car, anything you had saved for your children's education. So that can be very, very scary, and it can be very detrimental to a small business owner for that unlimited liability. Also, it's hard to raise capital. Banks won't give you as much money. You can't do a public offering on the exchange to get money. Also, there are less people to come up with new ideas and share responsibility. So if you're the one in control, it's only your ideas. Sometimes you become stagnant. And also, you have no one to share responsibility for. If you're making $1 million and you want to go to the beach, who can you leave the business with? maybe if you're making $1 million, you have coworkers, but especially in the early stages, it's very difficult to leave your business and you'll be working very long hours. Also, the business dies with the owner. If the business dies or leaves the business, then it becomes a new proprietorship. It's a different company. It's not the same as it was under the other proprietorship. Next, we have partnerships. You can have one to many owners and should have a partnership. Oh, I should say two to many owners and should have a partnership agreement. Pros, it's still easy to form and there's still little regulation. We don't have double taxation. The business is taxed through the partner's own personal income. And there's more people to spread the work through and come up with new ideas. If you and your partner work well together, where you are more detail oriented, the other person may be better at seeing the big picture. So that's really good. Cons, still that unlimited liability, and you can be liable for things the partner does in the partnership. So if the partner enters into a loan agreement, you are equally responsible. If the partner does something like makes bad lemonade, you're just as responsible as they are for the results of that. So you have to be you can be liable for someone else's mistakes that can be really dangerous as well. It's still difficult to raise capital. And the life of the partnership is limited to owners. If a partner leaves or enters, a new one enters, then it is actually a new partnership again. All partnerships must have one general partner that is responsible for debts and management of the business. Limited partners can be added and they have limited liability and should not manage the business. Limited partners are really many times just investors. They're there to give some money into your business and they become a partner so that they can share in your profits. And that's another con. You have to now share your profits with your other partners. So then we come to a corporation. A corporation is known by many. It can have one to many owners. It is a separate legal entity. So it is its own existence for laws. It has its own existence for taxation. Famously Mitt Romney said corporations are people too. I don't know if we agree with that, but they are certainly their own separate legal entity. So there are some pros to a corporation. First one is ease of raising capital. You can sell stock on an exchange, which makes it easier. Also, there's limited liability to the amount invested. So if I were a corporation and I had the same lemonade stand out there and someone got sick, they could only take what's invested in the business. They couldn't have my house or my savings account or any of that stuff. It's just limited to whatever amount I had invested into the lemonade stand. And that's true. If you own any stock and let's say you owned a piece of stock of BP, they couldn't come after you, the shareholder, for the mistakes of management. You're just an investor. So that protects us who buy shares in another corporation. Sometimes you don't think of yourself as an owner, but you are. And it can also continue beyond the owner's life. When people enter and leave the corporation, it doesn't affect the life of the corporation. You can buy and sell stock all the time. There are cons to corporations. First of all is double taxation. The business will pay taxes because it's its own separate legal entity, but also the person who is the investor in the form of dividends will receive the profits of the corporation, and they will also pay taxes on that. So you're taxed twice at a corporate level. There is regulation. The corporate government says you can't do this, or the federal government says you can't do this, you can't do that. There are regulations for the environment. There's regulations about how you would treat your employees. There's many, many regulations. You have to be sure you're following them. And that does come with costs. Not that regulations are necessarily bad, but for a business, that can be a con to have to make sure that you're following them properly to not be fined. And it's not easy to form. You have to go through the state and incorporate, and usually you'll have to have a lawyer, maybe an accountant, and it's not the same as just walking outside of your house and throwing down the lemonade stand. You have to do quite a bit more work. We'll have two more corporations that we're going to talk about. An LLC is a limited liability company. It's similar to a corporation as the owners have limited personal liability for debts and actions. It also has pass-through pass-through taxation. So the pass-through taxation is like a partnership, and that makes it better. They don't have the double taxation. And a subchapter S is a corporation that is small and files with the IRS for special designation as a subchapter S corporation, and then they get the benefits of limited liability and pass-through taxation. So this subchapter S was created by the IRS to help small businesses, and this limited liability company is more for accountants and doctors and lawyers that form partnerships but still wanted to have this limited liability. A franchise is something you may have heard of before. A franchise is a marketing right granting the use of the name, the trademark, or branded services or product. It's very popular in hospitality. I have a picture of McDonald's here because McDonald's is a franchise. There's a corporate McDonald's, and then small business owners apply to become a franchise, and then they have the right to use McDonald's. And actually, they have the obligation to have the same food, the same packaging, so that it's still homogeneous, but they get to use this trademark and have that recognizable brand and product. And again, many fast food and hotel chains are a franchise. Generally, there's an initial one-time fee with a franchise and the percentage of sales or set fees for the life of the business. So with a franchise, you may have to put down a large amount of money to start and then give them a fee every month. But it does have usually less risk because the franchisor, like corporate McDonald's, won't allow you to do it unless they feel that you're going to be successful. So generally less risk. Thanks for watching the video. I hope you learned more about Chapter 2. Please be sure to read Chapter 2 in its entirety and make sure that you watch the video for Chapter 3. Thanks and have a great day.